All right, thank you, Simon, and thanks to Round the Clock Trader for having me back once again. Today, we're going to talk about winter is coming, surviving and prospering during the upcoming bear market, and that's going to make a lot more sense, hopefully, in the next 20, 30 minutes. As usual, I want to thank all of you for attending. I appreciate you taking time out of your busy schedule to be here, and thanks to you guys for waiting around to the end of the day. So I appreciate that very much. And again, thank you, Simon. There's a disclaimer screen. You could read it if you get really bored. You can get it on my website. There are some actual things in there that's kind of interesting, like if you smoke after sex, you're doing it too fast and things like that. So I think that's kind of interesting. Uh, the bottom line is all predictions are about the future, and a lot of stuff can happen between now and then. Simon did a good job of introducing me, so I'm not going to bore you with a bio. So thank you for that, Simon. So what's today's presentation? Winter is coming. Any Game of Thrones fans here? I was not a fan of Game of Thrones because I never watched it, and a friend of mine talked me into watching it, and I've really been enjoying it. And if you're a fan of the show, you know that the Starks, especially that bastard Jon Snow, has been talking about winter is coming for, I guess, 6 years now, and winter actually might be here based on last week's episode. So along those lines, I want to talk about surviving and prospering during the upcoming bear market. Now you're probably thinking, well, wait a minute, Dave, how do you know? Well, flat out, I do not know. But I know two things. I know that markets go up and markets go down. I don't know if you guys have the Holiday Inn Express over there. Do you have the Holiday Inn Express, Simon? Do you know? But Holiday Inn Express in the United States has a gentleman who they use in their ads called Captain Obvious. So I don't know if this joke's going to translate.
We most certainly do, and we have the pleasure of watching the adverts every ad break as well.
Oh, fantastic. So I love Captain Obvious. He's one of my favorite characters on TV. And usually when I state the obvious, I talk about Captain Obvious. So markets do go up and markets do go down. And I think it's better to be safe than sorry. But you'd be surprised at how many people fail to realize when the tide may be turning, or markets, or even worse, that will actually fight markets in downtrends. Now, there's a few non-quantifiable things. And the reason I say non-quantifiable, because it's really hard to directly trade off of these things, but it's something that you notice just by paying attention. And over the years, you'll notice that these things tend to happen when the market's getting a little frothy, or could be in the early phases of getting in trouble. I don't know, I'm going to show my age here, but I remember when they came out with those stupid Dow 10,000 hats, and every day they would go out to the exchange, and it would be 9999, and it wouldn't quite get there, and some idiot would get a little overzealous, and he'd want to be the first to throw his Dow 10K hat to the audience. Well, in recent times, there's a big frenzy over here in our media, I don't know about your media, but about the Dow Jones being over 22,000. Now, again, you can't trade off of that, but it is a possible sign that we could be getting closer to a bear market. The other thing is there's been a lot of complacency, and people have come back to the buy and hold arguments. I actually saw I don't watch too much financial news. I try to avoid it like the plague, but I noticed the other day they were talking right before all this market began to slide and everything, how, boy, Dow's at 22,000, and all you had to do was just hang on. And then people who gave up in 2000 or 2009, it's amazing how fast it came back. And it's buy and hold will work until it don't. We've had two really bad bear markets in my lifetime, and I'm old, but I'm not that old. And in both of those bear markets, the major indices lost over half of their value. The other thing that has me concerned, and again, you can't quantify this or trade off of this, but the Trump administration, and I try to stay very neutral in my political views publicly. Privately, obviously, I have some opinions. But the Trump administration over here has been claiming the rally. So it's like, well, that's a slippery slope. So what's going to happen when the market begins to slide? Is that going to be your fault? And I've been in a lot of webinars recently where I'm on panels, and the participants on the panel seem to think almost like there's no question about it, this is just a correction. And it might just be a correction, but as you'll see in a few minutes, there are some things that have me concerned. And on a retail level, or I don't know if this gentleman's a professional or not, but this was on Facebook a couple days ago when the market rallied a little bit, and I think it sort of epitomizes what's really out there. Bear meat is so friggin' tasty. Any more sellers in the market for us to slaughter? Well, that's a little bit of overconfidence. And so I said, well, let's not start kissing each other just yet, which is a takeoff from Pulp Fiction, as you may recognize. I didn't say it quite so eloquently in Pulp Fiction. But this is something, again, non-quantifiable that I'm seeing out there, both on a professional and a retail level. And I assume this guy's retail because if you've been trading for a while, you would never go out and make such a cocky statement, or you would do it maybe once. So let's take a look at some signs and signals. Lately, we seem to have quite a few debacle du jours. Now, these charts are going back a couple of weeks when I first started getting concerned about market conditions. And if you go through, I don't know about the individual issues in England, but I notice over here, I look at about 2,000 stocks every day to get a feel for the market. And doing so, I notice a lot of debacle du jours, meaning that stock's just absolutely falling out of bed. And we had quite a few recently, and I just grabbed a sampling of some of the more higher volume stocks and some of the more names that might be known that have just absolutely fallen out of bed. Now, if one stock drops, it's no big deal, but that begins to weigh on the overall subsector, and it also can change the sentiment of other stocks in the sector, or people's sentiment towards other stocks in the sector, and that begins to weigh on the overall sector. And then obviously, as the sector begins to slide, it begins to weigh on the indices, and we're beginning to see that a bit now with the recent slide in the U.S. indices. Now, the other thing that has me very much concerned is the Russell 2000. I've nicknamed it the Rusty, as one of my clients calls it, so I call it the Rusty now. And it's formed what's called a bow tie, and I'm going to show you this pattern in just 1 minute. But a bow tie is simply when the moving averages come together over a short period of time, and I'll give you the actual setup in just 1 second, and begin to sell off, and then you look to go short after the first pullback. And you can see right here we had our first little pullback. So that would have been the trigger technically there, maybe a little bit further down, about 136.5. And if you didn't know anything about markets, and I often say always look at the chart first, well, you can see we were up here at all-time highs not too long ago, just in July. And then you could see about a week or so ago we were hitting these new lows. So from there to there, that's a pretty serious slide. And if time allows, I'm going to go to the real-time charts here in just a few minutes, and we'll take a look at some additional indices and some sectors. Now, the other thing that has me concerned is, and again, I would encourage you all to look at a lot of stocks daily. And there is a program in the UK, and I forget the name of it. I was actually briefly a distributor for a while, and I didn't get around to following up on it and all, but it will allow you to go through a lot of charts really quickly. I use Telechart in the United States. I'm actually an affiliate for them. And I forget the name of the program, but there's a really good program that you guys have over there that's similar to Telecharts, and you can look at a lot of stocks every day. I like to look at, again, about 2,000 stocks, which is the majority of my tradable universe. And in doing that, that's how I mostly find my setups. And you could see that out of the setups that I found, those that are checked off here, more and more and more are becoming short side setups. So a lot of times it pays attention to listen to the database, and usually it's a good sign of what to do. If you're seeing a lot of shorts setting up, then maybe you either want to pull your horns in a little bit and not be so bullish, or possibly even fire for short. Now, what action should be taken? Well, as a trend follower, keep in mind you're going to overstay your welcome. So it's okay to still be long at this juncture. In fact, we're still 100% long. And I'll show you that in just one second. Don't try to be a hero. A lot of gurus will predict early and often. I've known people who've been calling an actual signal. We have a signal. This market is going to head lower as this market goes higher and higher and higher. So be careful for those gurus that are always calling the top, predict early and often, okay? But when you see signs that momentum is changing, then you want to pay careful attention. So what I would recommend, if you're already long, then stay long. And we're still long, and you can see that we've got one in here that's doing really well. And this stock, we don't know, but it might continue to go higher. It's up 183% when I took the snapshot. Maybe it'll keep going higher. And then maybe these two stinkers we have in here could still work. Now, this one has since stopped out at a loss, but that's okay. Maybe this one will take off. The bottom line is you don't want to take any drastic action. You want to continue to follow your plan. Now, you want to be very, very selective on new positions. There's a couple of stocks I'm looking to buy now, but they're very speculative issues, and I think they have the potential to trade higher even if the market trades lower. And that could be something like an IPO, an initial public offering. Sometimes they can trade contrary to the overall market because there's this excitement in them. So what I would suggest is you consider the speculative and inefficient issues. I have a report on trading inefficient issues on my website under free reports if you're interested in that. I wouldn't rush out and buy commodity-related stocks, but if you do see some stocks that are setting up within the commodity area, such as metals and mining or something like that, then it might be worth a shot because they're not going to be held hostage as much by the overall market. Now, what I would encourage you to do right now is pay attention to the net price move. Now, this is just an example. The stock, I don't know what stock this is, but you could see that the moving averages on this particular stock had begun to roll over, even though the longer-term uptrend is still intact. And then also, if you look at the net price change, this is a very powerful concept, but very simple. Where's the market today? Well, that's a known. And where was it in the past, going back a week or two or a month or even longer, to see whether or not the stock or market has lost momentum. Now, I'd recommend that you dust off your transitional patterns. If you're not familiar with my trend transitional patterns, I'll show you two of my favorites that usually occur more often than any other patterns. Now, we're not trying to pick a top and we're not trying to catch a bottom, but what we're doing is we're looking for some sort of shift in momentum, and then we're looking to get in at the first signs of correction. Now, if we're trading just a generic pullback, we might wait for a solid trend, and we might wait for a nice deep pullback and look to get a little reversion to the mean move and all the other stuff that comes along with pullbacks. But if you're trading a transitional setup, you're looking to get in at the first signs of a correction. The reason is a lot of people will be waiting for that deeper pullback, and it may never come. Now, on the long side, we're looking for a market to bottom out, and we're looking for a new trend to begin. And again, we're looking to get in at the first signs of a correction if and only if that trend begins to resume. Now, keep in mind that sometimes it's a process and sometimes it's an event. Right now, I think we're having a bit of a process type of top. Now, a process type top, the market just kind of gradually rolls over and then it begins to slide, whereas an event is more of a sharp thrust lower followed by a pullback. And obviously, on the long side, you have a market that bottoms out for a while and then begins to take off again. Now, I purposely drew these as cup and handle patterns because a lot of times my transitional patterns will set up within something that looks like a cup and handle. So again, sometimes it's a process, and then sometimes It's an event. You'll have a sharp rally off of lows, then you look to get long after the first signs of a pullback. So let's take a look at the first thrust on the short side. And by the way, a lot of these slides you'll see are from my Trading Full Circle course, and Simon has some links for that on the website, so you check that out. Now, on the short side, we're looking for a sharp thrust lower after a market makes a new major high, ideally an all-time high. So right now it has me concerned. For instance, the Russell 2000 just made an all-time high, and now it's beginning to set up as a short side setup. And we're looking for a sharp thrust lower. It should be something very obvious and not just a normal pullback. And then we're looking to trade the first higher high and higher low. In some cases, you only get a higher low. And then we're looking to get short as the market begins to sell off from that level. Now, once we look at a few real examples, this will make more sense. Going back to 2000, late 2015, early 2016, the market was looking a little iffy, so I began to put on a few shorts, and here was one, and you could see it made a fairly sharp thrust lower after a double top. Now this is relative to the volatility of the stock. And then after that pullback, we look to get short, and then obviously we apply some money management. Now let's talk a little bit about a process top. A lot of times you'll have what I call a bow tie pattern, and here's the actual moving averages: a 10 simple, a 20 exponential, and a 30 exponential. And I do have a free report also on this if you're interested. And I realize we're going through this pretty quick. We're looking for them to flip over really quick, where notice the 30 is above the 20, is above the 10, and then in this particular case the 10 is now above the 20, above the 30. When they come together in a really tight area, you have a fulcrum point. And when we get to the live charts, I'll show you that again in the Russell 2000. So it's going to look something like this. And again, notice here the 30 is greater than the 10. I'm sorry, it's greater than 20, and the 20 is greater than the 10. If you were to back this chart out, you'll see that it's in a very long-term downtrend. Even though it looks like it's headed higher now, these moving averages were still in a longer-term downtrend, and they're just kind of in the early phases of turning. And then, again, they come together at the fulcrum point. And my litmus test for that is usually 3 or 4 days, or the way I qualify that. Sometimes it takes a little bit longer, but 3 or 4 days is a good point. Now, I know somebody's going to ask, can you use this on intraday charts? Absolutely. I'm not a huge fan of trading efficient markets. I mentioned earlier that I have an article on trading inefficient stocks. But I do like to trade hourly bow ties on Forex, especially if the contract is coming off of an all-time daily high or maybe a multi-year daily high. I like to look for shorts, and the same thing. Conversely, look for long hourly bow ties coming up from lows. Right now I'm short, I have to think about it for a second. I'm short the euro versus dollar, and I'm short the New Zealand versus US dollar based off these patterns. And again, after we see the change in the flip over and the bow ties, we're looking for a little bit of a pullback. It could be as little as a 1-bar pullback, and we're looking to get long if and only if that trend begins to resume. So if you go back to the Russell 2000 at the end of 2015, and this is why I was bearish in late 2015, fall of 2015, because we had a weekly bow tie sell signal. So again, as I said a second ago, these patterns are fractal. They work in daily time frames, they work in intraday time frames, and they work on much longer time frames. The weekly ones usually warn that you could be in the early phases of a bear market. Now, the Russell 2000 did not turn into a bear market, but it did drop 18% from the pattern. Now, for an index, an 18% drop is huge. In fact, our media over here, I don't know about your media, but our media over here gets all excited when there's a 20% drop in the market because they claim it's an official bear market then. So based on the media's metric, in all intents and purposes, this was nearly a bear market. Now, you do want to pay attention to major signals, and this is the weekly chart in the S&P 500. Notice that the bear market in 2000 had a weekly signal, and then we had a big leg down. We had a buy signal in 2003. We had a sell signal, again, on a weekly chart in 2007, 2008. And then, of course, we had another major buy coming off of major lows in 2009. Now, we had a minor sell in between and a minor buy in between, again, on a weekly chart. But your major signals come off of major all-time highs and major all-time lows. I think this is a euro going way back. In fact, I know this is a euro going way back on the daily chart. It did make a double top, and notice that this bow tie is off of all-time highs. And then, obviously, that's when the euro began to implode. So I would urge you to pay careful attention to those weekly signals. Now, when it comes to shorting a market, a couple things. Shorting is a little tougher than it looks. I remember when I first learned that you could make money on the short side, I'm like, well, crap, I'm losing money in my longs anyway, might as well short. It was a lot harder than it looked. And that's because you have these sharp retrace rallies. Technically, you can only make 100% if you're not trading around a position, which is a little bit more complex thing that I don't want to get into too much today. But technically, yes, you can only make 100% profit on a short. And your losses are unlimited, but that's only if you're stupid and obstinate. And you would also have to have unlimited cash. Your broker is kind enough, or will be kind enough, to exit your position should you run out of margin. And then obviously there's some logistics. You could actually be called out of a position, and that's a little bit more than I want to get into today, but just trust me, you have to borrow the stock, you could get called back. So I'm kind of building a case against shorts, it would seem, but there's a reason why you should short markets. Obviously, it's the only way to make money in down markets, but there's another reason for that. It helps for you to see both sides of the market. I have friends that run millions and millions of dollars, and those who are long only oriented tend to always see the market as being half full, or the glass is half full, I should say, instead of half empty. So that's one reason I encourage you to short. It does help you to see both sides of the market, and that's why you've had so many buying whole people being so complacent lately, and people posting stupid things like bear meat is tasty. It's like, what a dumbass. Anyway, here's a beautiful thing right here that excites me. All major tops and bottoms will have a transitional pattern. Now, not every transitional pattern will turn into the mother of all tops. I hope the Russell 2000 does not turn into the mother of all tops, but we have a daily signal. Now, daily signal is a valid signal, and you do have to pay attention to that signal, but I would get very concerned if we had a weekly signal, because in the S&P 500 and in the NASDAQ, every weekly signal for the last 30 years has turned into a bull market or a bear market. So you want to pay careful attention to that. Now, none of these indices are anywhere close to a weekly signal, so I don't want to be fear-mongering just yet, but I would encourage you to pay attention to these signals. And by the way, the reason that I want to get in front of this potential bear market is that it might not happen tomorrow. I hope it doesn't happen tomorrow. It might not happen next week or this fall, and I hope it doesn't. But when it does, if you know these patterns, you're going to be ready, and you're going to recognize it when it does. Just in case I get hit by a beer truck and I'm no longer around, you can't email me. A couple of random thoughts. I wouldn't rush out and sell the forum. I wouldn't panic just yet. If you're long, stay long. I always believe in following each position to its fruition. Let the stop take you out. Again, I'm hoping for the best, but I'm bracing for the worst. And remember, if the market does go into new highs, everyone will feel like we dodged a bullet, and that's going to likely beget even more buying. Unfortunately, though, when the market starts failing to make new highs and begins to weaken, never forget that people buy and sell stocks for a variety of reasons. And somebody might need money to retire. They might need money for junior to go to college. And if that money begins to erode, then they may be tempted to pull that money out of the market. Whereas if the market's making new highs, then everybody's happy. and it keeps the buy and hope crowd happy. Also, remember this: a market's job, so to speak, is to confuse and confound the most. So this could just be one more shakeout before the market takes off yet again. And we will have enough time to get to the live chart, so I want to show you a few things as far as maybe it is a shakeout. I don't know yet, but as a trend follower, you have to remember that you will be a little late to the game, and you will end up overstaying your welcome a little bit sometimes. So in order to follow a trend, you must first have a trend to follow. So let me just put up my contact information, and then we'll jump into the live charts. DaveLandry.com obviously is my website, and my email is dave@davelandry.com. I answer all emails personally. Okay, let's take a look at a few live charts in here, and hopefully, let's see if this thing is still up. Yeah, I got to pull up my charts. I just looked at it on an old computer, and that the program that I used to use to look at a lot of stocks was ShareScope. I don't have any affiliation with them anymore. I didn't, nothing ever came of it, but that's what I used over there. Over here, I use TC2000. If you're interested in looking at United States equities, if you go to my website and you click on the new to my methodology or new to trading, there's a link on that page. And by the way, there's a lot of free information on that page, so get to know me first, and then that way you'll understand where I come from and all this. All right, let's take a look at these indices over here. The Russell 2000, as I've been saying, has formed both a first thrust down, see the big thrust here, followed by a pullback, okay? So that's set up as a short, and it actually set up as a bow tie, as I showed in the slides just recently. And again, this is a bow tie off of all-time highs, so it's important for you to pay attention to that. Now, there's nothing magical about the 50-day moving average, and I only tend to dust them off and look at them when the market's in trouble or bottoming, whatever the case may be. But you can see that it's now trading well below its 50-day moving average, and I'll show you a little pattern here in just one second too. So that's a little concerning, and again, a 200-day moving average, I look at that even less frequently, but it is well watched, and anything that's well watched sometimes is worth watching. And the Russell 2000 is now below its 200-day moving average. So that's a little bit concerning. Now, Russell 2000, if you're not familiar, is 2,000 stocks, so it's a broad-based index. Now, let's take a look at the NASDAQ, and this is the pattern I want to show you. Very simple pattern. I call it daylight. One of my clients emailed me this morning. He says, if you're looking for a nickname for a setup that I have off of daylight, he called it Dave Light, so I like that too. I wrote an article in 1995 where I talked about buying markets as they pull away from the moving average, and the low would have to be greater than the moving average. And somebody wrote me and said, I like that concept, and he dubbed it daylight, because you could see light, so to speak, between the price and the moving average. Now, let me just clean this chart up a little bit. Let's go, but let's just look at 50-day moving average. When we put the 50 in by itself, you could see that we've had daylight for nearly all of this leg higher. And now, once again, we're testing the moving average. I don't suggest you rush out and trade directly off of daylight in a moving average, but it can help to keep you on the right side of the market. And you can see we had a test here back in April. We had a test over the summer, and now, once again, we had a test below the 50-day moving averages. So far, it has survived. So I'm not saying rush out and sell the farm, but you might want to have it appraised, okay, just in case. Now, take a look at S&P 500. Same sort of action going on there, too. Notice long periods of daylight in here when the market is headed higher, and then now, once again, we're having a bit of a test. Now, on a micro level, you know, this guy's saying bear meat is tasty. Well, that was on this day here, and we've already given up a sizable portion of those gains. So I wouldn't be that confident just because the market is bouncing. Now, what would negate all this? Obviously, again, new highs, okay? I would stop being so concerned if the market went on the new highs. Now, if you look at the sectors over here, you can see the transports had this first thrust down, and now they're breaking down to new lows, so that's concerning. The major airlines, you can see pretty serious slide lower. And by the way, these are also bow ties. You can see nice little crossing of a bow tie. I didn't get any prettier than that. That's a perfect little setup there. And you can see pretty serious slide out of that. And as you go through all the sectors, you'll see more and more sectors are looking like this, or at least kind of dubious at best. Here's the banks in the U.S. You can see a recent little slide there, pulling back a little bit. If you drill down to the regional banks, they look like they're in a little bit of trouble. Here's drugs. You can see a little slide pulling back a little bit. So most of these areas, manufacturing, for instance, you've got a bow tie down. It's a little sloppy. It didn't cross right away, but you can still see that you got a pretty serious slide in place here. And materials and construction, you can see made a bow tie down, little slide pulling back again, but it looks like they're in trouble, especially the back to chart out a little bit after hitting these all-time highs. So there's not enough time to go through all these areas, but there's only a few in here, such as defense, and that's probably thanks to Mr. Kim Jong-un, I suppose, that are definitely headed higher, obviously headed higher. For the most part, most areas are looking sort of dubious at best. So pay attention to these transitional setups. Pay attention to the debacle du jour if you're seeing a lot of stocks getting hit. And then pay attention to a lot of these sectors in here, both major and not so major, that could be in early phases of rolling over. And I think that just go in with your eyes open. No need, again, to take any drastic action. Just make sure you're honoring your stops on existing longs. Make sure you're very selective on new ones. And then the third thing I would do is start to consider a short or two. Again, not because you're going to get rich on the short side, but it does help you to see both sides of the market. And at least you'll make a little bit of money if a bear trend does begin to develop. So we could open it up for questions if you guys are ready. Or have any, I should say.
Thank you, Dave. That's fantastic. So let's give people a couple of minutes to write some questions down. So, I mean, your message is not obviously doom and gloom, but it is to be defensive.
Yes, because we don't have a weekly signal. We don't have a major weekly signal. We'll take a look at the Russell 2000. We'll take a look at the weekly chart. And you can see we're just beginning to slowly turn on the weekly. You can see these moving averages have begun to move down. So I guess my message, you're right. It's just let's just be a little defensive in here. Let's just have our eyes open. Let's not, just because the market's going up for however many years now, 9 years or 8 years, whatever it is, it doesn't mean it's going to continue to head higher. What you see is not all there is, which I think comes from Thinking Fast and Slow, a very good book on psychology. But let's be cautious in here and let's be careful.
And what sort of products do you use? Do you use derivative products to sort of set up a hedge on your portfolio? Do you use options or?
Well, I don't believe in hedging per se, because I think a hedge is a waste of money, and it's very difficult to get it right. Let's say you hedge your portfolio and you're long, and let's say the market keeps going higher. Well, now your hedge has cost you money, and the money you made on your portfolio is offset by your hedge. Well, let's say the market sells off hard. Well, your hedge will make money, but you lost money on your positions. So it's expensive to hedge, and it always tends to just kind of net out. I would prefer to just use a trailing stop to take me out when I'm wrong, or just a flat-out regular stop if it's a new position. And then I believe in letting the ebb and flow control the portfolio. So if the market starts taking you out of your longs, sometimes that in and of itself could be a signal that things are worsening. Hedging, I'd be very careful with that. I know he's actually he's the most famous option guy out there that runs a fund. He does a certain type of hedging, but he really knows what he's doing, and he's hedging against other long options and stuff. It's a very complex way of doing things. So unless you dedicate your life to it like he has, I think that a hedge is just a waste of a lot of money.
I've heard that. I heard other people saying the same thing. Richard says, does Dave recommend a definite short stock in the main high liquidity shares?
Well, there's none in particular that come to mind, but earlier in the webinar today, somebody was asking me about Amazon. Well, notice that Amazon has made a bow tie down, and that has actually already triggered. It triggered right around this 985 level or so. So maybe watch something like Amazon for a bounce. Now, I like to trade more speculative issues such as IPOs and smaller cap stocks, but on the downside, and again, this would be another good, it seems like a pump in these free reports, but I have a free report out there called Go NOMO, and the Mo means momentum. It's like when these momentum stocks that are big cap, well watched, like Amazon's and someday maybe even Apple, just these huge stocks, when they do begin to crack because they're everybody's darlings and you start seeing these transitional setups, you can have a fairly substantial move lower. So I would read that special report on that and keep an eye out for when the market does crack. So I sort of look for just the opposite. For instance, this is a long stock we're long here, which is you see the volatility here, this is historical volatility, very high, and it's a less known stock. It's called Kemet, K-E-M, and we got long way back in January, and we're just trailing a stop on this one. So that's what I like to look for in a long setup. But in a short setup, I'm more excited about a big cap issue, as someone in the audience just pointed out, something with a lot of volume that you could actually trade.
Richard's come back and says, just on hedging, hedges make money for Wall Street wolves, not for investors.
I fully agree. I fully agree. Very tough. Very tough business.
As in the World Trade Center restaurant scene of the movie.
Yeah.
And I recall that well, the Fugazi. Just never, as long as they don't sell the stock. It's okay.
Yeah.
Good point, Richard. Thank you for that.
Yeah, well said.
Okay. Any other questions? I think we've exhausted people today. Unless there's any key questions. Dave, I just recently published one of your articles.
Well, thank you.
On the website, which was great. I know it's part of a series, but I can see it's already getting quite a lot of traffic, which is good. So people that might want to follow that, you can either go to londoninvestmentweek.com or go straight to Dave Landry's website, davelandry.com. I took some time just to go through the website, and there was a huge amount of information that you've got there, which is great. So I urge you to go and check out a lot of the articles you've written, because you managed to inject a humorous side to them as well. You do well with these images, and it brings it to life, which is great.
Yeah, well, I try not to take myself too serious. I mean, this business is serious enough, but I just try to take myself too serious. The market humbles me quite often, so I just kind of go with the flow with it all. But I appreciate the kind words, Simon.
Great. I'm just going to type it at davelandry.com. Richard's just asking where the website is. There it is for everybody. It says, how do you trade gaps? Do you have a system for trading gaps?
I have a pattern for gaps. I actually believe in trading in the direction of the gap, and let me see if I could show you real quick how I do that. It doesn't occur that often. It's not one of my bread and butter type of setups, but it is something that I have observed. And you want to see a gap in the direction of the trend. Since we talked about shorts, let's see the market rolls over, and let's say you have a gap down. Look for like a little pullback after that gap down, and I call it explosion gap pivot. So that's, if I were going to trade a gap, I wouldn't say, well, a gap's going to get filled, because a lot of times they don't. A gap, I guess the bottom line is, just because we don't have much time, but see a gap as a support or resistance level. And if you have a stock, let's say, that gaps down and it rallies up to that gap, it might be a good place to look to begin to short, if and only if it begins to sell off. Now, just real quick, let's say we have we're looking to get long a setup and it looks like this, and then somewhere in the setup there's a gap, I would ignore the setup unless it is a commodity-related issue. So a gap within the setup should be ignored, and if you're going to trade gaps, trade in the direction of the gap. Don't look for that gap to get filled.
Fantastic. I've posted these links to the articles on the website now. Fantastic. Any other final questions before we let Dave go?
Now I'll show you one more thing with gaps while you're waiting.
Okay.
I have a pattern called a TKO, which you can get under videos, and I'll see about getting that over to you, Simon. I'm not a huge fan of intraday trading, but sometimes, let's say you have a market sells off hard, especially if it's in a really big uptrend. Sometimes you'll get a gap lower and then it'll go back up. That's called an opening gap reversal, or as I call it, an ogre, O-G-R-E. So if you get an ogre, trade it in the direction of trend, maybe when it takes out the low in here. This is a little bit more advanced type of technique, and this is something that I don't do very often unless the conditions are fantastic. So I don't want to say too much about this, like this is something I do every day, and it doesn't occur that often either, but that's another way that I handle gaps.
Okay. Continuation, breakaway, exhaustion. I'm saying.
Yeah, I'm not. Yeah, it's like the continuation. I believe more of a continuation type. I guess if I had to pick one, it would be more of continuation. The exhaustion, only in shorter term trading like this opening gap reversal. You come in and let's say the market's in a really strong uptrend, and then you have that gap down overnight. Sometimes that's better to be faded than traded. But again, this is not your bread and butter. Taking an intraday position like this. Now, in really good conditions, it can be, if you have a daily setup, you can get a head start on a daily setup. That's a little bit more advanced techniques, but that's how I would handle it.
Wayne, it says, what about the moving averages? Can you confirm what you said earlier about moving averages?
I like a 10 simple, a 20 exponential, and a 30 exponential. And again, I'm going to refer you back to the special reports. I like the bow tie moving averages, especially after all-time highs or major multi-year highs or major multi-year lows. I will look at a 50-day simple and then sometimes even a 200 simple in something like an index when things get to be a little iffy like now. And that's why I just spent a little time talking about the 50-day moving average in the NASDAQ and in the S&P 500. And I know you're recording these, so if once they're up on, I assume you're going to put them on YouTube, you might want to go in and rewatch that. And also, I recorded my webinar earlier today where I talked a lot about moving averages, and I'll put that up on YouTube later today. It'll take me about 3 hours to process it, but it should be up there at some point if you check my website or check YouTube for that.
Fantastic. Fantastic.